In this video, we're going to talk about Mmat materials, trading under the ticker symbol MMAT. At the moment, the financial market is very volatile, and we should be careful about which stocks to buy and what is the exposure and timing of our positions. This video will cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest events. If that's the case, I will then make follow-up videos to reflect them. With that being said, let's begin with today's topic. During recent trading sessions, the stock increased to almost $2. We should pay attention to the $1.80 level nearby because it was tested one time as a support, sure. But because it is a very recent level, the stock is on an ascending trend. It is a significant level to watch out for to determine if MMAT is in the bullish trend. Over the past 30 days, the trend of the stock has been bullish overall and has been ranging between $1.80 and $2 level for the past week or so. This means that the market is partially retracing and regrouping and will then decide whether it should go up again. From the perspective of longer time frames, the trend of the stock has been bearish as the company had significant drops in its stock price, and so far those losses are not gained back yet. When we look at the price trend overall, it's been accelerating and probably going upward, given the market is currently seeing its tide being reversed along with the rest of the Nasdaq. The trading volume of Mmat material is recently 3.8 million shares versus the average volume of 5.5 million shares. Over the previous 52-week period, its price fluctuated between $1.38 and $21.76. The market cap of Mmat materials is currently around $545 million versus an enterprise value of $530 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has high leverage or a negative image amongst market participants, its asset value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, some of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company can generate more profit or to have more growth than another company, partially because it has a good management, a stronger brand recognition, or a bigger online following. It is what makes a company unique compared to its alternatives. In other words, it may not be a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount. The market cap is often lower than the enterprise value since the enterprise value includes this arbitrary value given to goodwill, and because the enterprise value is less reactive as well. But if the company goes to liquidation, we're not going to see any goodwill left, and we would be left with the debt holders to share amongst each other whatever that is left on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 30% higher than its 1-month low, 33% higher than the 3-month low, and 33% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 151% versus the historical volatility of 125%. The put-call volume ratio is currently 0.18. It is normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 2.9 thousand contracts a day versus the 30-day average of 4.3 thousand. Regarding the open interest, The most recent volume of open interest is 99,000 contracts versus the 30-day average of 102,000 contracts. For the shareholder structure, institutional owners have about 27% of the outstanding shares. The biggest shareholders include State Street, Vanguard, and BlackRock. It is relevant to understand the shareholder composition of a company as it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, a lot of exceptions may apply, as many great companies are held by retail traders as well, but that tends to be the exception and not the rule. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there may be more significant interest in the short side of things from the institutional traders. The current short interest is 17% of the total float, and 59% of the transactions are occurring from the dark pools or out of the exchange. Overall, my opinion on Mmat or Metamaterials is bullish because the stock is located at a very interesting price level for the short and medium price point, which is very interesting for those looking to hold it long term and those who want to trade the swings. The maximum exposure I would then recommend is between 3 to 5% of your portfolio. For the immediate term, my recommendation is to buy the stock considering that the recent price actions and the promising price levels that are very close to where it is right now. I would recommend to separate the allocation in batches of 20% at a time so that you can have enough room for later buys. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.